Hello, everyone. Welcome to today's deep dive session. My name is Dami, and I have with me here Markus Wolf, who is one of the partners at bpExperts. Hello, Markus, and welcome.
Hello, Tami. Welcome and thanks for having me. I'm excited to be here today.
Thank you, Markus. Today, we're discussing how organizations can bridge the gap between transformation and strategy and execution through business flows framework, with a particular focus on the finance domain in the process industry. Markus, let me jump right into it. Many organizations already have process maps and repositories. So what makes business flows framework fundamentally different from others in practice?
There's one fundamental differentiator of business flows from any other kind of collection of process maps, process master lists, and best practices. Business flows has from the beginning been designed as a framework to provide process knowledge to stakeholders for their different practical use cases. From a strategy perspective, from the need of program and project managers to drive their transformation initiatives, from business managers and process owners to design and optimize processes, to the various groups within an organization with a need for documentation. I think there is a lot of similarity to the role of finance today in an enterprise with the many perspectives and needs of its different stakeholders.
Thank you very much, Marcus, for that response. What really stands out to me is that you're describing something that is much broader in practice than a process repository. And we are really talking about a framework that helps different stakeholders, from executives to process owners, make better transformation decisions. That naturally begs the next question about business value. So if I were a CFO in the process industry, why should I care about business flows beyond compliance and or documentation?
Whether your company plans a large transformation or engages in smaller projects, transformative projects, or runs an improvement and optimization initiative, as a CFO, you are always confronted with basically two questions. First one, how to design processes in finance and in other domains to realize intended impact on financial KPIs with the right transformation. It is about getting the transparency right. This allows you to have clear decisions on investing into the right applications, customization efforts, and improvement potentials to achieve measurable result and to generate value. Looking on the disruptive changes and the dynamics caused by geopolitical developments, technology developments, and social trends, the second question becomes increasingly more and more relevant for all kinds of enterprises. How can we have integrated processes that enable finance simulate the implication of changes to markets, supply chains, and own processes on finance KPIs? Tools to perform any kind of simulations and analytics are available, but it is your process design that feeds those tools with a realistic and useful representation of your current business. Some might call this digital twin. The CFO needs this knowledge to inform and advise the CEO and his team to fine-tune their responses, not to overreact nor to underreact to what's happening.
Yeah, so I guess that the real value isn't the documentation at all, it's the transparency. Transparency in how operational processes influence financial outcomes and ultimately the ability to anticipate and respond to these changes with confidence. Which leads me to ask, where does finance fit within the broader business flows architecture? If you can explain the finance domain and its role within an organization.
As mentioned, finance has to serve a large variety of different stakeholders, and it is the most integrated domain. A large number of business processes affecting finance do actually originate in other domains, representing the variety of operations of a company. This is what many conventional business repositories and academic models struggle with. Let me show you this in a live demo. So this is our map for the process industry, and you see here in the middle we have the finance domain together with the different other operational domains what we typically have in an enterprise. So let me briefly explain the structure of our domain maps. So what you can see here on the top is our generic end-to-end domain flow. So this represents the whole picture of what happens in the finance domain. We will then go further into detail in these two lower areas. Here we will have the different specific use cases, what we say end-to-end scenarios. And we also will have later a look into the transformational drivers which influence our decisions during the transformation. So let me zoom in into our end-to-end view. And I think this end-to-end view already represents how those different stakeholders and aspects of finance impact the process repository. So, of course, everything starts with planning our financial activities, planning our budgets. So we have a process group covering all the processes for this financial planning and budgeting. But then on the other side, you have a large number of mainly individual day-to-day activities. You might call it processes, but it's practically financial transactions that you perform every day in connection with many different areas like accounts payable, accounts receivable, transactions related to credit management, tax accounting, cash and bank accounting, general ledger, or specific intercompany group accounting transactions. If we move on, then of course, there are also aspects which relate to cost controlling, product costing, project accounting. So the whole controlling aspects are also on a day-to-day or periodical level to be performed. But then there's also the governance aspects like financial risk management, and you have your treasury operations. Last but not least, we go into the reporting from a controlling perspective into profitability analysis, into management reporting, the external reporting, what you need to provide, as well as treasury accounting, what you handle on a more global level as well. This is the main structure and provides you with all relevant processes below those groups. So from this generic model, if you look now in the different use cases, and let's pick the example here of daily operations in accounts payable. So there are our so-called end-to-end scenarios where we clearly show that the individual processes in the end-to-end flow differ depending on certain circumstances. And those scenarios here you see is there's a difference in vendor invoice clearing, whether this is based on the purchase order in the system, or if you have to do this without a reference to any purchase order in the system, which is typically the case in some areas of indirect procurement scenarios and so on. And there's also the aspect of credit and debit memos, which are related to those transactions. So here we separate this and bring the individual processes what are performed in context with the larger business process from an end-to-end perspective.
Absolutely. I think you made an important distinction there between the process groups themselves and the different use cases and the end-to-end scenarios. And it just goes to point out that finance isn't just another functional domain. It's effectively where the operational reality of an enterprise comes together. And if that's true, understanding finance means understanding the different connections to every other part of the organization. The question I would like to ask now is, how does business flows handle this cross-functional dependencies, for example, between finance and supply chain and production?
So let me go back to our entry model and start the view actually from lead to cash. So there we have a similar structure, and if we pick an easy example, for example, the sales of stock products, then you already see the integration of finance related processes like here, the execute credit management, which is performed actually twice because you perform it when you create a sales order, but also before you actually fulfill the sales order. And there is an integration into dedicated scenarios in finance that follow up on those business transactions, like we see here with the customer invoice clearing. And this integration is to the respective representation of our finance scenarios. So here you see in the customer invoice clearing, this flow of processes is actually triggered by many different areas, clusters, we call it. So it can be a product sales, it can be a service sales, it can be custom projects or billing and payments. So there are many different integrations, and this transparency supports an early alignment between the domains, which leads basically to the consistency and comprehensiveness of your design decision, and therefore avoids delays because of those dependencies during the project.
Yeah. What I'm hearing is that many of the challenges organizations may experience later in the transformation can actually be traced back to like a misalignment in the earlier processes, because those dependencies even become very more interesting in industries where operations themselves are highly interconnected. Now, speaking specifically, what do you think makes the process industry fundamentally different from discrete manufacturing when it comes to finance processes?
So it is less that what you do in finance that differs between those industries. It is more the how, or even more precise, what factors you have to focus on. If you take costing as an example, in the process industry, it is recipe-based, whereas in the discrete manufacturing, we are typically unit-based. Your focus on the input factors are accumulated costs on processes, batches, reactors, or formulas, and the outputs are weight, volume, concentrations. The cost allocation needs to be done on grades or by and co-products. In discrete manufacturing, often product level standard costing and bill of material based costing roll-ups are applied. The inventory valuation is often more complex as well. In process industry, it is influenced by the change of material properties during production and expected but variable yield losses. Quality grades affect value. Inventory may exist as liquids, powders, gases, or semi-finished mixtures that are influenced by environmental conditions such as temperature. Therefore, finance must account for yield variances, shrinkage, evaporation losses, potency adjustments, and grade differentials. Those are just examples, and there is not always a clear-cut line between the industries. If you look at individual enterprises especially. That is why, despite our industry-specific references, we also foresee to combine them for an individual customer case. Commodity prices are definitely a huge topic in the process industry, but they are as well relevant for discrete manufacturers dealing with products including, for example,
Absolutely.
precious metals or other expensive raw materials.
Yeah, that's really a fascinating perspective, because what you're essentially saying is that the distinction isn't so much in the function itself, but in the operational characteristics that the finance function has to model and account for. Building on that, how do factors like batch management, buy and co-products, or even things like global supply chain challenges, like we're currently facing, influence the finance process design?
That brings us to our third areas in our process map, the transformational drivers. So let me show this on an example of the driver about cost optimization and operational efficiencies. So if we look one level deeper, then you see that we have mapped already many different capabilities to those transformational drivers. And let's pick the co and byproduct costing and output management as an example.
Yeah.
So here we clearly describe what we understand as the business capability, co and byproduct costing and outputs, how relevant it is to have this transparency and to allocate costs properly. But in addition, we also reference this already directly to the SAP scope items so that you can have your direct link to the standard SAP documentation as well as the reference to the SAP solutions available for that, so that we can also verify in different deployment scenarios, whether it's a cloud private edition or public edition, in which solutions those capabilities are actually provided.
Excellent. So ultimately, the answer depends on what the business is trying to achieve, and the transformation drivers determine which aspects of the process landscape deserve the most attention. So that brings us to a question maybe many finance leaders might be struggling with today. What would you say are the top 3 unique finance challenges in the process industries, and how is the business flows framework positioned to alleviate these challenges?
Go back. So before I directly answer your question, let me explain a little bit how business flows should be used in this context. So we looked at the generic end-to-end processes and on those end-to-end scenarios which represent all a company's business use case. And they are derived from the operating models. So basically those two parts of our framework support especially the scoping of your initiative. So if you go and select what is needed to support your operating model, and then what individual processes, either as part of those operating models of those end-to-end scenarios, or as a typical standalone activities companies perform in the various areas we went through, in those process groups, you define this is the scope, what we need to cover in the initiative. But this is just one part you need for steering, because it doesn't answer you the question, where do I need to invest? Where do I need to focus on to achieve my transformation objectives? And for this defining the focus, this is the transformation driver area where we facilitate the discussion on what is essential for you to transform, where do you need to invest into your design. So now I'm coming to your question. So the key focus of a transformation initiative from a finance perspective, what we see is integrated business planning and scenario modeling. So compared with many discrete manufacturers, process companies generally gain more value from advanced scenario planning because raw material costs often represent a much larger share of total costs. Second aspect is margin and cost to serve analytics. In the past, finance focused on standard costing and variance reporting. Today, leading process in companies need much deeper visibility into product profitability, customer profitability, channel profitability, and asset profitability. Third, we have the capital allocation and asset performance management. Process industries are among the most capital intensive sectors in the world. Finance therefore needs strong capability and evaluation and analysis of assets, and as well on sustainability investments, life cycle costs, and maintenance and reliability costs. It is hence important to achieve the necessary timeliness, accuracy, and granularity on cost and revenue allocations, and to connect operational data and engineering and maintenance data with financial outputs. benefits. Cost optimization and operational efficiency should therefore be understood as enabler for those capabilities, not as an overall cost reduction in finance. Our framework of transformational drivers and underlying capabilities provide the necessary structure and causal relationships to decide on the focus areas and to guide the project teams through a design and implementation, not losing this focus. It is one thing to say you will reduce working capital or increase some other financial KPIs. We ensure management and project team understand how and why your initiative will provide those benefits.
Absolutely. I mean, it sounds like one of the biggest challenges is balancing the breadth with the depth and understanding the full end-to-end landscape without losing focus of the areas that actually drive value. In your experience, what are the most common inefficiencies you see in finance processes before transformation?
When we look at the last 20 years, there have not been many substantial changes in finance. And those changes which happened were rather add-ons, especially if you think about new concepts in controlling. It turns natural that no end-to-end redesign of finance processes took place. The business requirements typically also developed gradually. New business models or revenue streams start as exceptions. Same for different collaborations with suppliers and other business partners. But they meanwhile represent a substantial part of the company's operation. Therefore, many companies suffer from a combination of a narrow and inflexible optimization, what they have done, and automation of processes, and a growing volume of originally called exceptional cases. So typically the latter are still sufficiently covered from a compliance and regulatory reporting perspective, but drive efforts in daily processing as well as covering them properly in reporting and analytics. The design of many processes was limited by organizational and technical factors which do not exist today anymore, but only few of them were consequently updated. Another historical driver for inefficiencies is mergers and acquisitions and reorganizations.
Mm.
Those
Yeah, yeah.
especially affect processes such as period end closing, consolidation, and reconciliation of transactions between legal entities of the group. The root cause is often in different operational processes or their representation in the systems. Business flows is meant to steer holistically the redesign of an enterprise's processes and thus to enable finance influencing design decisions from the beginning on this overall end-to-end perspective.
Yeah, thank you. You know what's really interesting is that many of those inefficiencies you discussed are actually not really technology problems at all. They are often like symptoms of fragmented processes, fragmented data, disconnected decision making. Moving ahead, one of the core ideas you bring is mapping strategic drivers to business capabilities and then to SAP scope items. Can you walk us through how that actually works in real life?
Let us have a look at another transformational driver. Automation of invoicing and reconciliation, reducing efforts and improving efficiencies. So if we go deeper and look what capabilities we have here, then we see already different use cases, new ways of doing businesses like self-billing or subscription billing and invoicing integration. So let's assume that you have included subscriptions into your overall customer service. So how the framework helps you is not just showing you here the capability, but it shows you also the reference how SAP supports this. And it's also linked directly to the SAP documentation. So we are not replacing SAP, we are providing an extension to the SAP documentation with all the information as well as a direct link into the SAP documentation. So you have immediately access to the relevant SAP documentation, and you can familiarize yourself with the SAP processes and fully understand how those features from SAP support you in efficiently managing subscriptions and what different variants of process flows you have, like creating a subscription or billing the subscription and so on.
Yeah.
Basically, this methodology helps you to not just calculate a business case, but to really understand how your transformation will impact your operations performance. Some of those efficiencies may come by just implementing S4. However, in order to leverage the full potential and build your capabilities, it is important to consider those in fine-tuning your processes, adapting your managerial and operational decision-making processes and policies, but especially communicating those aspects to the whole organization to adjust habits and influence day-to-day behavior. This is why we bring SAP processes and business processes together to support your whole project team and all stakeholders in achieving this transformation.
Absolutely. What I find interesting is that you're describing transformation as a lot more than system implementation. And the technology may enable the change, but the real value comes in understanding how the capabilities and the processes and even the behaviors evolve around it. Naturally, this brings me to another concept that gets talked about a lot in transformation programs, which is that everyone really talks about end-to-end processes, but in reality, we find that organizations are still very siloed. So what does true end-to-end thinking actually look like?
From a finance perspective, true end-to-end thinking goes beyond simple connecting business processes. It means understanding both the process interactions and the financial consequences of operational activities across the entire value chain. Let us go back to our example of sales of stock products.
Yeah.
There are two dimensions to this integration. So the first is process integration. Finance does not operate only at the end of a transaction. It is involved throughout the process lifecycle. For example, in an order to cash process, finance is not only responsible for monitoring customer payments and recording revenue, it also plays a role in credit management, collections, and bad debt prevention. What you see here in this integration with execute credit management, for example, as I mentioned, happening multiple times throughout the sales process. True end-to-end thinking requires finance requirements to be considered wherever business decisions and transactions are initiated, not only where accounting entries are posted. So the second and often overlooked dimension is value flow integration. Some operational activities have financial impact on the organization. Production activities generate labor costs, material consumption variances, and inventory movements. Sales activities generate revenue, cost of goods sold, discounts, and profitability impacts. Procurement activities create commitments, liabilities, and cash flow implementations. Let's have a look how those are represented here. What we integrated in our process documentation is this connection, what we can call value flows. So you can show which of the business transactions, which of those processes actually have a context to your value flow. And here you see by creating custom invoice, we have multiple aspects of a value flow: the accounts receivable posting, the revenue recognition posting, and the output tax posting. With this reference, we are able to immediately provide process owners in finance and the decision makers in finance with an overview which operational processes and their different variances actually have an impact and might be considered in maybe a different way, depending on the context of the scenario which in one is executed. So creating a customer invoice for a product sales is probably a straightforward and clear understanding how your revenue recognition happens. But if you consider other scenarios, renting scenarios, or providing the possibility to clients to return the product will have an impact. And giving this overview on what scenarios actually have this context to a certain value flow, you are capable of designing your finance activities and your requirements in finance at the same time while the colleagues in the operational domains do their detailed design, because we implement these connections and these references already from the beginning via our business flows. So by providing this information in a structured way, we can not only see from this path that sales from stock actually leads to a revenue recognition posting, we can actually also look from the other perspective, in the other direction, and look where else we actually create revenue recognition postings. And then you see that it's not just for customer invoices, it's also for intercompany invoices, for invoices when you sell spare parts, invoices which are related to milestone billing rather than just to a simple product sales, as well as even assets, what you might sell.
Yeah.
The challenge is that finance often has visibility into the accounting results, but limited transparency in the operational activities that generated them. As a result, organizations can struggle to understand the true cost drivers, revenue drivers, and profitability drivers behind their financial performance. Organizations may remain structurally siloed, but true end-to-end thinking is achieved when operational decisions and financial consequences are designed, understood, and managed as part of a single integrated value chain.
Excellent. Now we've established that end-to-end thinking is ultimately about connecting operational decisions with financial outcomes. The obvious question then becomes, if a company wants to start using this approach, what's the first practical step?
Obviously, the first step should be getting in touch with us. Our approach starts with defining the future operating model and the mode of operations that should be covered by the processes. Putting those in context and aligning them with your strategy and objectives of your transformation will result in not just some nice looking PowerPoint slides, but in a process framework which will enable you to steer your whole transformation initiative while safeguarding your value realization.
Great. What I like about this approach is that it starts with the business intent rather than the process documentation. So what you're defining is you're defining where the organization wants to go first before deciding how the process should support it. Now, looking ahead, what role do you think automation and AI would play in shaping business flows?
We are already on this journey. Especially agentic AI provides us with the necessary speed to exploit the full potential of our framework. Business Flows provides the structure and the methodology. Our experienced consultants are responsible for the quality and for the essential human interactions with experts, managers, and staff of our clients, integrated with AI agents in a hybrid team.
Now, that's an important perspective because there's often a tendency to view AI as a replacement for process design. But what you're suggesting is that it's almost the opposite. The better your process architecture, the more efficiently you can leverage AI. It's an excellent point. Now, moving on, how do you see finance processes evolving over the next 3 to 5 years in the process industry?
So the role of finance, and especially the interactions with its stakeholder groups, will change significantly in the next years. With another role, the processes will change as well. On one side, automation and AI agents will reduce the transactional workload, and the role of employees in finance will be more of a supervisor role, ensuring quality and overseeing processes in a hybrid organization. Analytics will go much more into details, and the interpretation of insights will require deep understanding of the company's operations. The role changes from data provider to business advisor. Future finance will connect financial and operational data. Integrated planning and simulations require an understanding of your P&L and of production and supply chain processes. The integrated value steering will not be just on the manager level, but will be much more integrated into daily operations. Thus, a new stakeholder group will become relevant to support and advise with its own dynamics in terms of responsiveness, granularity, and process knowledge.
What's striking for me in finance is that finance appears to be moving closer to the operational core of the business. And the future finance organization seems to be a lot less focused on recording what has happened in the past and focused more on influencing what happens next, which gives us an excellent food for thought in the coming years. Now, given that shift, if you were to challenge one common belief about finance transformation, what would it be?
Finance and controlling will become small in terms of manual processing, but more influential in strategic decision making. But you should not believe that there is one transformation for finance. The organizations that succeed will be those that combine AI-driven automation with strong business and operational understanding to build the capability of transformation. The shift from functional finance to integrated value steering will be the first phase. Those will be followed by evolutionary developments of AI-augmented decision-making and enterprise value optimization.
This is a very fitting note to end on. And throughout this conversation, really, one common theme that has emerged is that successful transformation isn't just about implementing a technology platform or just adopting a set of best practices. It's more about creating the transparency and connecting the financial and operational value flows, and by extension, building those capabilities that allow organizations to continuously adapt. And I do believe that the organizations that succeed eventually won't simply automate finance. They will use finance as a mechanism for steering the business. So in closing, thank you very much, Marcus, for the engaging conversation. Do you have any last words?
Thank you very much for giving me the opportunity to show an example of how domain finance, how business flows can support transformation initiatives. And it was a pleasure being here today.
Thank you very much. Today we've explored how the business flows framework help organizations to move beyond functional silos and understand the true drivers of performance and build the capabilities that are needed to adapt in an increasingly complex business environment. If you have made it this far, I would encourage you to reflect on one question. Do you really understand how your business processes drive your financial outcomes, and are you able to change them with confidence? And finally, if you're currently evaluating your transformation roadmap, or you're simply trying to better understand or connect business processes with business outcomes, or you're just interested in learning more about business flows framework, we'll be interested in hearing from you. You can reach out to us or connect with our guest today, Marcus. Thank you very much for joining us, and we'll see you on the next episode.